On the It's the Economy segment, I have a guest who has written a very interesting blog, which I think every investor and every policy maker needs to read. First, let me introduce my guest. Aseem Dhru is CEO and Managing Director of SBFC Finance, an NBFC that he started in 2017. But before that, he spent 25 years in HDFC Bank. And given his 30-odd years in lending loans, I would take Aseem very seriously. And what is Aseem Dhru's blog saying? Dhru says that in his latest blog, that the tidal wave of retail loans that banks and NBFCs and Fintechs and MFIs have all been lending may be in a bit of trouble. That he's clearly seeing signs of loan quality deteriorating. But let me get it from the man himself. Aseem, thank you very much indeed for joining us. Your blog is titled, The Traffic Lights Are Flashing Amber. Can you say what's worrying you about loan quality?
So banking sector usually has this tendency of moving from one extreme to another. And that's something that one has to constantly watch for. So what has happened over the last few years is that corporate loans have just not taken off. Investments have been not coming in. And therefore, retail has become a crowded trade where all banks have got in. So there are banks and there are NBFCs and there are Fintechs, etc. All of them, the name of the game had become consumer lending. So what has happened is that the balance sheet has got tilted a little. So if you look at the overall lending balance sheet of the 143 trillion loans that are there in the country, 100 trillion is household debt. And if you break that up, then you have 15% of that is agriculture, 25% of that is businesses. Because we have these small businesses, which is unique to India, which is an extension of the individual. And then you have got balance as personal loans, 60%, of which mortgage loans comprise 30%. What happens is that if you look at what concerns me, is that in this country we have got closely about 8 crore people who file income tax return, of which about 3 crore people pay tax. This is the real base on which lending happens. So when you look at percentages of debt to individuals, it may appear low, but it is concentrated on these few individuals
3 crore people
who are taking the load. So when you look at that concentration, the DSR of retail appears high. In their balance sheet, when you look at a macro level, when savings are dropping and your leverage is going up, that's a classic point where one is concerned that is the retail Indian consumer in a balance sheet problem.
Is he able to serve? Will he be able to continue to service his debt? Is the point you're raising. Well, I know the figures that RBI puts out are lagged, but the Financial Stability Report pointed out rather triumphantly that GNPAs, gross NPAs for the entire banking and financial sector is at an all-time low of 2.8%. So how much bad can it get at all? We are, after all, working from very good base, don't you think?
No, absolutely. This need be read, in a different light. So if you look at it, we have never had a better country balance sheet. The country balance sheet is in absolute great health. We have never had a better banking balance sheet. The banking balance sheet is in superb health. We have never had a better corporate balance sheet. The corporate balance sheets also are in superb health.
Completely.
So the only little concern, is the retail balance sheets, where the households may have stretched a little. Inflation may have hurt them more than what we acknowledge. Incomes may not have risen to the level that their consumption aspirations have risen to. So somewhere the little concern is on the household balance sheet, but these are niggles that, so all I've said is that there is a issue that we need to recognize and slow down before we overdo it.
I agree with you. And the Reserve Bank appears to have smelt the same rat that you are. And way back in November, it's almost a year now, that they moved ahead with unsecured loan risk weights increases. You think that is not enough? You think it needs to slow down much more?
So one of the things that the regulator has been driving on, and rightly so, is that what are non-end-use monitored loans is what is on the radar. And one of the reasons, that they're doing this also is that if the loan is not going towards consumption, then is it going towards non-productive use? And anecdotally, one sees that there are certain habits, in terms of whether it is the stock market has also behaved in a particular way, and the retail balance sheet has moved towards the stock market. A lot of people may be making a mistake of confusing a fixed deposit versus a mutual fund SIP, considering both as a risk-free asset class, which is not the case. So I think that is warranted is that one is seeing, velocity of debt is more concerning than the absolute level of debt. So when a retail consumer starts taking loan number 2, 3, 4, at some point of time the lenders will have to draw a line and put the discipline of lending in place. Because when you overdo anything, it always ends one way. So it is better to be a little careful, and as a banker, you are always concerned because you are managing some cycle or the other. Either it's an interest rate cycle, or it's a credit cycle, or it's a liquidity cycle. You are managing some cycle or the other. It is always better to be prudent and cautious rather than be reckless about it.
Too aggressive. Go for growth at any cost. Your own GNPA. Now I'm coming to SBFC. Your GNPA actually fell from 2.4 to GNPA rose a bit from 2.43. It has come to 2.6 quarter on quarter. But what stood out for me in your Q1 numbers is that your disbursals are down. So should I understand that you all have already become cautious?
So last quarter was a little bit of an exception because there was a RBI regulation change,
yes,
where the disbursals had to be accounted for at a point of time that you are actually giving out the check to the customer. So that was a 1 month lag that adjustment took place.
So what accounting issue?
Otherwise, it is business as usual.
Okay. But have you all personally increased scrutiny of unsecured loans? I guess for you, a larger part is retail and unsecured, right?
We do only secured loans, and we do only to small businesses in small towns of India. So for us, it's always been a secured lending.
But wouldn't it be cash flow lending?
It is cash flow lending backed by collateral. But what happens is that you do increase the gates of entry. When you see risks building in the system, you increase the gates of entry. So for example, earlier we used to have a CIBIL cutoff of 670. We have now pushed it up to 700. And we have brought in several other measures tightening it. Plus, we are more cautious of loans already availed before applying for a loan with us. And when we see the velocity of loan building before coming in, it could be unsecured loans, consumer loans, etc. Then we are a little more careful. Okay. So I would say that the mood is of cautious optimism. It is still optimistic, but a little bit cautious now.
But the economy has not yet seen the corporate sector pick up the baton, yes, or at least not so far. We are still seeing the capex coming from government and consumption coming from households through leverage. So do you think that if the capex, private capex cycle, I'm not saying it's not there, but it is not like anything it was in 2004 to 2008, then do you think we'll see a drop in loan growth?
See, actually, it's very interesting that it is not that capex is not happening. Corporate capex is happening in a limited way. No major projects coming through.
But with internal accruals.
But internal accruals and stock markets. So now it is at this valuation. Any corporate board will advise saying, why don't you do a QIP and raise the money? Why take debt at all?
Okay, so basically your point is that we are in a bit of a danger in terms of unsecured loans. So a little more risk weight from the regulator would be par for the course?
So it is not only, that has already been done. And what tends to happen is that risk weight then ultimately gets transferred to the borrower in terms of pricing. Okay. And the borrower will a desperate borrower will take a higher pricing. So the worry is, and that every lender has to be cautious for his own good.
So the caution must come from the lender, not really from the regulator. Point taken. Thank you very much. Your blogs are widely read. So I suppose it will be internalized by many a banker. Thank you very much for dropping in the studio. We have to wind up on Bazaar. Chartbusters coming up.